The clock is ticking toward what could be one of the most important speeches of Jerome Powell's career. The Fed chair delivering remarks Thursday at the Fed's annual economic symposium, usually held in Jackson Hole, Wyoming. Not this year. Let's bring in Steve LIESMAN with more on what we can expect. So I guess no fishing for you, Steve, no fishing for any of those guys this year. Last year, it's interesting, it was the trade war that he was going to comment on.
There was never any fishing, Melissa.
Oh, sorry.
Melissa, there was never any
fishing and no live music either, right? Never.
Yeah, you need to get your story straight on that. It was all work all the time.
Yeah, I'll fact check better.
Go ahead. Sorry,
here.
what was your question?
Last year, he had the challenge of the trade war to sort of navigate around, and this year it is a global pandemic. What do you think he's going to set the table for?
Well, I think he's going to set the table for all of that. He's had a pretty consistent message on that, which is I think that the markets and policymakers need to hope for the best and plan for the worst. The Fed has been pretty consistent on this, Melissa, that the possibilities of worse outcomes are at least an even chance. And he has urged the fiscal side to get ready to do more and to do more, while at the same time saying that the Fed is wide open. But there's a broader thing going on, Melissa, as you know, which has to do with this strategic review the Federal Reserve is going to be involved in. And they're going to lay out this new policy that we think is going to involve average inflation. And essentially, I think the way to think about that is letting inflation run a little hotter for a while so that to make up for the lost inflation of years past. And, they have not hit their 2% target for, I don't know, almost a decade now, maybe once in the past decade or so. But they really haven't hit it. And the idea of average inflation would be don't raise rates until you're making up for the inflation that you lost.
So basically, this is going to be a very long-term sort of plan then. I mean, there's no sign of inflation. So the thought of introducing this is sort of, it's almost comical.
I wouldn't quite go comical, but I will say that I join you, Melissa, if what you mean is skeptical, because I do mean that. First of all, I'm not sure this represents a change to any of your traders' understanding of what the Fed is going to do. I mean, Powell made a very consequential shift pretty early on in his tenure, which was to say, we're not trying to get back to normal. We're only going to raise rates when we see inflation. And then this pandemic came along, and I think Powell has also been pretty clear about the idea that we are not preemptively raising inflation. We're going to keep rates down. And in response to one of my questions, once he said, we're not even thinking about raising interest rates. And then in response to the next meeting to another reporter's questions, he said, we're not thinking about raising rates. And so he added another thinking about there, which means I think that all of your traders are kind of sitting pretty, relatively comfortable that they are not in the horizon that they care about looking at any interest rate hikes. What the Fed now is doing is, I think, are formalizing a procedure. I don't think it changes very much that's out there. It does formalize something that is now policy.
You think that there would be any talk of asset bubbles, namely the stock market, or negative rates?
I think the Fed has also been pretty consistent about that, they do not want monetary policy to be the swing factor when it comes to asset bubbles, in the sense that if they have an asset bubble that affects the banks that they supervise, they want to handle that through supervision, not through monetary policy, and deprive the economy of the monetary policy that they think it needs. I know where you're getting at.
They're the ultimate swing factor in this market. That's the thing.
They're more than the swing factor, Melissa. You're right. I'm just saying that concern, and don't blame me for this, because, Guy likes to slap me around like it's my fault. But I'm just pointing out that the Fed, as far as I can tell, does not embrace the concern that monetary policy will cause asset bubbles. They want to be able to provide the monetary policy that the economy needs. And if they have a problem with stocks or assets, they want to address that through the supervisory method. That's been I've been able to, every time I've asked them, every time I've reported on it, that's the general consensus that I pick up.
All right. Steve, great to speak with you. Thank you.
Pleasure. Thank you.
Steve LIESMAN, who does not fish or play music typically at the Jackson Hole Symposium. Guy Adami, I will go to you since Steve accused you of slapping him around.
That's patently false. I love Steve knows that. I have the utmost respect. Nobody reports on the Fed and what's been going on with the Fed for the last however many years better than Steve LIESMAN. I've said that many times, and I'll stand by that. My problem is the things that they don't, that the Fed doesn't talk about. For example, I understand the dollar is not their purview, but I'll say again for the 100th time, their actions have led to this fall in the U.S. dollar. And whether you accept it or not, a falling dollar is inflationary, almost by definition. BK mentioned lumber prices. You mentioned asset prices. So inflation is all around. But I said this yesterday. I think one of the main reasons the market took off late in the day was the news that they were going to this profoundly, extraordinarily speech that they were going to make about the way they view inflation, the way they measure it. And I think that's very bullish for the equity market. I don't particularly like it, but it doesn't matter what I like and don't like.